Today, I'm going to show you how I make a full-time passive income with decentralized finance. Now, the first thing I want to mention is there's absolutely no such thing as passive income, and that goes for all types of investing. And that's because any type of investment is going to require some work from you on your end, no matter what you're investing into. So when I say that I'm making a full-time income from passive income in DeFi, I mean that the money is doing all the work for me. I'm not trading time for money. The money works all day long. But at the end of the day, I do have to monitor my positions. I do have to adjust them sometimes, and I do have to create new ones sometimes. But for the most part, since I have a long-term portfolio set up, it's pretty hands-off for me now, which just allows me to go in there every now and then, collect my earnings, either compound them or of course send them over to my bank account. The first thing I want to talk about is DeFi passive income. There are DeFi lending platforms. This is where you can lend out your assets and get a very small percentage on them, usually maybe 2 to 3%. You can also go and stake your DeFi tokens. This is like Ethereum or maybe Matic or AVAX or so on and so forth, where you're supporting the decentralization of the network by staking your assets into a validator. And there's also providing liquidity. This is where people are swapping one asset for another asset on Uniswap, Curve, so on and so forth, and you are providing liquidity, allowing those swaps to happen and collecting a small fee. This is the most lucrative in my opinion. But of course, all of these are going to require you to check up on your positions, although liquidity providing is going to be the one that's the least passive. You're going to have to check up on it on the most. Staking is more of a set it and forget it. You're still going to have to occasionally check on it. And then DeFi lending platforms, once again, very similar to staking. You're still going to have to check up on it every now and then to make sure things are going good. So with that being said, within the DeFi space, there are some things that are more passive than others. That's the moral of the story. So what we're going to do in this video is actually break down the best balance between passiveness as well as yield. Because of course, the things that aren't as passive are usually going to give you a higher yield. So we're going to find a balance in between there. But with that being said, I want to do the same thing with real estate. You have some things that are super passive and other things that aren't passive at all. For example, fix and flips, where you go and you buy a rundown house and you fix it up and then you flip it for a profit. That is not passive whatsoever. You have to manage contractors, you have to manage buying the property, so on and so forth. Even let's just say traditional rentals where you have a long-term tenant in there. You have to go and screen tenants. You have to go and find good deals on properties. You have to go and make sure that you're getting rent. If the toilet gets broken, you have to go and fix the toilet, or you have to manage somebody to actually do it for you. And there's ways to make these traditional rentals more passive through property management companies and stuff like that. But even then, they don't go completely passive. They still have some extent of work from you. And then REITs, let's just say, you have to go and actually do the research to find the investment that's going to be best for you. You have to monitor it every now and then to make sure that it's performing as expected, or if you need to switch it into a different REIT. And then of course, same thing goes with stocks. You have to go and you have to pick your dividend stocks that are going to pay you the best dividends, but also allow for growth of capital. With that being said, a lot of you guys probably don't know what decentralized finance is. So I'm going to break down what DeFi is pretty quickly. In centralized finance, which is your traditional banking system, everything relies on a single entity. So for example, there might be many accounts or many different companies or so on and so forth, but they all rely on this central entity. Whereas in decentralized finance, everything relies on each other. So for example, you might have plenty of validators and nodes all around the world relying on each other rather than relying on a centralized entity. And that's because they're all connected instead of all just being connected to the main network. And the best part about this is on decentralized networks like Ethereum, anybody can actually host a validator, a node, so on and so forth, meaning they can participate in the decentralization of the network, which ultimately causes the network to be completely decentralized when you have thousands of people all over the world in different countries with different opinions and different interests hosting this decentralized network. And with that being said, DeFi, which stands for decentralized finance, is just a financial industry on a decentralized network known as a blockchain like Ethereum or Bitcoin or so on and so forth. And on these decentralized networks known as blockchains, there are something called decentralized applications, also known as dApps. You have ones that will allow you to do lending and borrowing, which means you can go and collateralize your Ethereum maybe and borrow some stable coins against it, which ultimately allows you to leverage up a little bit on your position. And you can do whatever you want with these stable coins. You can go and reinvest them to leverage up. You can go and use them to pay your mortgage. You can do whatever you want with them. There's also platforms like Uniswap that allow you to swap one asset for another asset. For example, if I wanted to swap my Ethereum for USDC, or if I wanted to swap my Ethereum for OV token, which is the token of the platform we just took a look at. Or maybe I want to swap my OV token for something called ApeCoin. Then I could do that on a decentralized exchange known as Uniswap or any of the other decentralized exchanges out there. Now, real quickly, I want to mention that I do have a free DeFi passive income starter guide down below in the description. As always, it's 100% free. You guys know that by now. It breaks down how exactly I went from $0 to over $2,000 in DeFi passive income. Now, what I like to do is find cryptocurrency assets that I am personally bullish on. Now, I will say right now, I'm pretty vanilla when it comes to my investments. I like Bitcoin, and the reason why is because Bitcoin is like digital gold. It's the one that starts and ends the bull run. And of course, Bitcoin is a proven concept. It's similar to the S&P 500, but it's within the crypto space. So I like to allocate a little bit of my portfolio there. I also believe in the Ethereum ecosystem, and that's because Ethereum is the gas token of the Ethereum smart contract network. And the Ethereum smart contract network allows anybody to create a decentralized application, allows anybody to create an NFT, allows anybody to create their own crypto token. So with that being said, the Ethereum network essentially allows decentralized finance to happen, and it is where DeFi was actually created. So I'm a big believer in the Ethereum network, so I'd include Ethereum in my portfolio. And if we go down the list of popular cryptocurrencies, there's one called Matic that I'm also a big believer in because they're a layer 2 scaling solution to Ethereum, which basically means that they are a network just like the Ethereum network, but they have very cheap gas cost instead of maybe $10 to $15 per transaction like the Ethereum network has. So what I would do is I would just go and find different cryptocurrencies that I am bullish on. And if you guys want me to make a video on my overall due diligence process and research process, make sure to drop a like and subscribe, but also drop a comment saying drop that video. That way I know for sure that you guys do want me to make a video on that topic. But essentially the first step is just finding crypto assets that you are bullish on. Now in this case, I already have my list documented right here. We have Bitcoin, we have Ethereum, Matic, Lido, SHIB, Bone, Link, Aave, Pendle, Render. Each one of these, I have a different reason for liking that cryptocurrency, and I do think that there is going to be growth in each of these crypto assets. So yes, I could just wait for these crypto assets to rise in price. Maybe over the course of the next 4 years, Bitcoin goes to $100,000. It's currently at $30,000. I would about 3x my money. So if I had $10,000, I would have about $33,000-ish. But what we're actually going to do, instead of just waiting for these assets to go up, we're going to make money when they go up, but we're also going to earn a yield on them, which allows us to compound back into our position to the point where we can increase our exposure over time. So that way, when Bitcoin does go to $100,000, I don't have, let's just say 0.33 Bitcoin. I have maybe 0.4 Bitcoin, which allows me to make even more money. And to break that down a little bit further, say one Bitcoin currently equals $30,000 right now. And I purchased one whole Bitcoin right now, but over the course of the next 2 years, it goes to $90,000. Well, then now my one Bitcoin is worth $90,000. But what if over those 2 years, I accumulated an additional 0.5 BTC, which means I now have 1.5 BTC tokens, but I only paid for one. That's the yield that I'm talking about here. Now I actually have $135,000 because I have 1.5 Bitcoin instead of just one Bitcoin. That is exactly what I'm going to show you how to do in this video, so keep watching. So the next step is obviously to find different strategies that allows you to retain exposure to all these assets on your list, but actually earn a yield on them as well. I like to use a tool called DeFi Llama, but I'm not completely reliant on DeFi Llama because it doesn't go as advanced as I usually go in some of my strategies. But if we look at the yield rankings for Bitcoin, you can see that a lot of these are actually going to be liquidity pools that have super low yields. And one thing I will mention is if you do want something relatively safe and consistent, I recommend to sort the TVL by over $1 million because that means that there is actually some liquidity behind these pairs. Now in this case, we can get a 225% APY on Bitcoin to USDC on Trader Joe, which is a liquidity platform. But we have something called impermanent loss. And that basically means that over time, our Bitcoin is going to be shifted into USDC. And we don't want that because that's going to cause a lot of impermanent loss. And of course, we want to retain full exposure to Bitcoin, not just Bitcoin and USDC. So if we go to attribute, we can search by no impermanent loss right here. But now we have limited opportunities here. We do have something with 8.86%, which I guess isn't too bad. But if you look at it, there is a 1% base APY and a 7% reward APY. That basically means that we're being paid out in a reward token that is being inflated in supply over time, which means that the price of that reward token is going to go down over time. So we just want to mainly look at the high base APY things. And what you'll basically want to do is just go down this list and conduct due diligence on all of the different pools, analyze the risk to reward ratio, what risk you're actually taking on, and all that good stuff. Now I know I can get a 10% APR on Bitcoin by just simply lending it out on Aave, borrowing stablecoins against it, and investing those stablecoins into market neutral liquidity pools. Now with ETH, it's a little bit of a different story because we can actually stake ETH for about a 4 to 5% yield. So we could stop there, just get our 5% APR, or we could leverage up a little bit on that stake and get maybe an 8% APR. Or if we really wanted to, we can go and actually borrow just like we did with Bitcoin and invest into liquidity pools that are market neutral. So I know we could get about a a 12% APR on Ethereum. Now on Matic, it's even better. We could get about a 15% APR. And keep in mind, none of these passive income plays have impermanent loss, so you're not really going to have to monitor them as much. Now, if we search for Lido on DeFi Llama with the TVL of over $1 million and no impermanent loss, you can see there are absolutely no pools. But if we check off the no impermanent loss, you can see that a few pools do start to pop up. Specifically, I want to look at this Lido to wrapped Ethereum pair on Uniswap v3. This is a concentrated liquidity pool, which essentially allows us to range down our liquidity to a specific price range instead of doing a full price range from $0 to infinity dollars. Now I'm thinking that we can actually pair Lido with Ethereum, so we retain exposure to Ethereum, but we also retain exposure to Lido token, which ultimately allows us to make money when both the assets go up. And since Lido and Ethereum are both very closely correlated, this would make a pretty good pool where we can actually get around 50% annualized. And I usually like to go ahead and play around with the range and test that out on a tool called uniswap.fish for calculating Uniswap v3 pools. Now I'll go ahead and put in a pretty broad range. I'll do my due diligence and I'll analyze the pool just to see what range is possible and what it's going to yield. In this case, it's estimating around 50% annualized, which is pretty good for my liking. So I'm just going to go ahead and put 50% APR on Lido. And we're just going to keep going down the list and doing that same exact thing. For SHIB, it's a similar situation. There's not many single staking pools, so we'd want to do the same thing with SHIB to Ethereum liquidity pool. So now I've gone down the list and I've found yield opportunities for each of these assets, and I'm actually going to go and invest into these yield opportunities now. But in order to do that, I need to map out how much capital I have, what current assets I have, and where I'm investing that capital. So let's just say this is a list of my assets right here and their proper allocations. I currently have, let's just say, $58,000 across all of these different assets. The next step is to figure out what we're going to do single staking for and what we're going to pair two assets together for a liquidity pool. So what I'm going to do is I'm just going to document that. With Wrap Bitcoin, we're just going to do single staking. With Ethereum, we're going to do single staking, but the other thing is we're going to need Ethereum to pair with some of these other assets on our list. So we're also going to check two assets there. With Matic, we're going to do single staking as well. With Lido, it's going to be two assets, and so on and so forth down the list. Now you'll notice if we look at this Uniswap v3 calculator right here, it says for this Lido pair, we need to put up $575 worth of Lido and $424 worth of Ethereum. So it's a little bit different, but most of the time it's going to be around the 50-50 range, and I'm not going to go into the full details here. So we're just going to assume that if we're putting up $4,000 of Lido, we need to put up $4,000 worth of Ethereum. So if we do our math here, we need $23,000 worth of Ethereum. We only have $20,000 worth of Ethereum, but we also want to single stake some of our Ethereum. So that makes it a little bit tricky. Well, we have a few different options. What we can do here is we can leverage up a little bit. We can go over to a platform called Lido and stake our Ethereum for a 4% yield. That's our single staking. Then we can borrow against this stake on OV, maybe borrow about $15,000 worth of Ethereum. And then we could use that $15,000 worth of Ethereum to go and invest into these liquidity pools. But the issue is we're going to have impermanent loss and we might lose some of our Ethereum. So that's a little bit risky, and you shouldn't do that unless you know what you're doing. That's just one of the opportunities. The other thing is we can reduce our exposure to some of these assets and convert that to Ethereum. That way we have enough Ethereum. So that's exactly what I would do in this situation. I would reduce my exposure to some of these other assets and put that back in Ethereum, so that way I can use that Ethereum to pair with these positions. So now you can see that we still have $58,000. We just have 26K of Ethereum rather than 20K, and then we only need 17K worth of Ethereum instead of 23K. So this would work out. We need 17K worth of Ethereum. That means that we can actually stake $9,000 worth of Ethereum. So what we'll do is we'll just add together the amounts that we're going to put in each pool. For the single staking, it's going to be relatively easy, whereas with the other assets, with pairing liquidity, for example, we're putting up 3K worth of Lido and 3K worth of Ethereum. That's 6K, so on and so forth. And then we're just going to go ahead and input the yields that we calculated previously. So as you can see, we've now calculated how much dollars we're actually going to be making every single year. And the best part is you can do anything you want with this. You can compound it back into the position, which is what I would do in the bear market, or in the bull market, you can actually go ahead and claim these, sell these off as profit, and take that money and put it into your bank account, or just sit in stable coins, whatever it may be. But in this case, it's estimated about a $30,000 return off of our 58K every single year, which is about a 53% annualized yield, which is really nice. But I will say nothing is going to be guaranteed here. All this stuff is estimates. This Bitcoin yield could simply go down to 5%. It could go down to 1%, or if we're borrowing, it could go down to like -3 or 4%. Another thing is we could witness capital fluctuations, meaning that our initial stake could go down to, let's just say, $50,000 as opposed to the ordinary $58,000. But the same thing can happen if we're just holding those ordinary assets, and as long as you are properly structuring your strategies, you're going to be completely fine with outperforming the market, because that should be your overall goal here. Your goal should not be to make money, which I know that sounds crazy, but your goal should be to outperform the overall market if you're to hold your ordinary assets. And the best way to represent that is through one of these liquidity pools, which is the Ethereum to USDC pool. As you can see at the start, we were just right in line with the market, and actually sometimes the market was outperforming us right at the beginning. For reference, this blue line represents this liquidity position. The green line represents if we were to hold, let's just say, our initial assets, which was about $7,000 full in Ethereum, and the gray line represents if we were to hold our initial Ethereum plus our initial USDC. So as you can see, over time, the divergence between this blue line and the other lines becomes greater. That's because we are collecting fees on this position. So now you can see that we have $7,326 in this position if you account for fees. If we were to hold all of our $7,000 initially in Ethereum, we would have about $7,024. If we were to hold all of our initial Ethereum plus USDC, we would have $7,007. So since we're in this liquidity pool, we have about $300 more, which is great, and that's the perfect example of how you outperform the market in a situation like this, which ultimately means same thing goes vice versa. If the price of our initial assets right up here went down, then what would actually happen in an ideal scenario is maybe they went down to $50,000. We would have $52,000 because we're generating that yield from our positions. That's going to wrap up today's video on how I make a full-time passive income through decentralized finance. Don't forget to check out my free DeFi passive income guide. There is a lot of information in there, and I recommend you don't miss out on it. Don't forget to drop a like and subscribe when notifications turned on if you want to learn more about this concept of decentralized finance and how it is changing the world. I'll see you guys in the next one, and peace out.